Hi, everyone. Good morning or afternoon, depending on where you are, and welcome to our webinar today. This webinar is hosted by SOFTRAX and Vindicia, and today we'll be discussing revenue recognition, implementation considerations, and the impact on subscription services. And yes, that's a mouthful, but hopefully after this webinar, it'll be a piece of cake to understand and to navigate. My name is Stephanie. I'll be in the background and here for support. So feel free to chat me if you're having any issues, and I will help try to resolve them for you. Also, you can chat and pass along to me any questions you have. You can send them at any time during the webinar. I'm going to be collecting them, and we're going to use the last 10 to 15 minutes of the hour for Q&A. So now I'm going to go ahead and introduce our speakers. First, we have Kristen, who is a sales engineer from SOFTRAX. She's out of their Boston office, and she's focused on coordinating and streamlining the pre-sales process. She's also an active CPA in Massachusetts. And then we have Begoya from Vindicia. He currently serves as Director of Product Management, and he has over 20 years experience in the industry. So without further ado, I'll go ahead and hand it over to them so we can get started.
Hi everyone, this is Kristen. Thank you so much for being here today, and thank you to Vindicia for partnering with us on this webinar. I am going to start us off with just a brief overview. So I know there's been a lot of commentary, and let's be honest, fear-mongering in the industry about the new revenue recognition standards. And I think it's interesting to hear it not only coming from companies, but also from vendors of revenue recognition solutions. Some keep saying that these are the biggest accounting guideline changes to happen in decades. And as an accountant, I can certainly agree to some degree that these new guidelines have initiated sweeping changes for all industries. So I'm not going to tell you to ignore the commotion. Just listen to what they're really saying, because as a revenue recognition solution provider, I can tell you that those of you in the subscription businesses can relax. Based on what we've seen here at SOFTRAX, as well as what our friends at Vindicia have seen, most subscription services will only need to make minor changes in order to comply with the new standards. Of course, it all depends on your business and its current operating model, but you should take comfort knowing that many subscription services already work in the way the guidelines dictate. And now we'll cover the new guidance, particularly as it pertains to the subscription business model. We have customers who are in all stages of adopting and reporting on the new standards, so we are happy to provide insight into this discussion around the changes and how to best approach any challenges you may be facing. So Begoya is going to begin.
Thank you, Kristen. Before we go any further, let me clarify what we're talking about when we say the new guidelines and standards. About a decade ago, the Financial Accounting Standards Board and the International Accounting Standards Board recognized a couple of significant problems. The generally accepted accounting principles in the US differed from the International Financial Reporting Standards, and two companies engaging in financially similar transactions could be required to report their revenue in a very different ways. This discrepancy was often problematic, both for companies that operated in numerous countries and for those only doing business within one. For example, a business operating in multiple countries may have to recognize revenue in different ways for each market. Additionally, the IASB sometimes provided incomplete guidance, making it very difficult for some businesses to recognize revenue when they have a complex transaction. To solve these problems, the Financial Accounting Standards Board and the International Accounting Standards Board created a single set of international accounting standards, defining a 5-step process that everyone has been talking about in their updated titled Revenue from Contracts with Customers. If you follow the news in these accounting changes, over the past 2 years or so, you're probably familiar with these 5 steps. In essence, they're designed to help businesses recognize revenue in a manner that matches what the client is paying for. To achieve this goal, the new GAAP asks that the businesses complete the following tasks. They need to identify the contract with their customers, identify their performance obligations, determine the price of their products or services, allocate the transaction prices to match the performance obligations defined in the contract, and recognize revenue as performance obligations are satisfied. Kristen will go through each one of these steps and demystify them next.
Thanks, Lagoya. So the first one is identify the contract with your customers. In the first stage, your business must clearly identify the goods or services it provides and each party's rights to them. So we've provided a couple of questions that go along with this from the subscription perspective that should be considered before moving into the next steps. First, you should be asking, when and how are these goods and services delivered or assessed? Daily, monthly, or even less frequently? And when does the customer's access to these goods or services end? So if you think about a standard contract for subscription, the goods or services provided are generally a license for subscription software, bundled with anything from a setup or activation fee to support, maintenance, and services. In this scenario, how are you delivering these? From the revenue recognition perspective, you may be looking at recognition of the license and any fees at the time of delivery, meaning the customer receives the license on day one, so you start recognizing the revenue. However, the support or maintenance and services have to be amortized over the life of the contract because they're ongoing service commitments. Again, it depends on your business model and the particulars, but that's a pretty standard scenario. So now that you've defined your contract and considered what goods and services are there, we move to step 2, identify your performance obligations. So step 2, identify your performance obligations, meaning exactly what do you owe to your customers. These become your obligations to perform via the terms of the contract. Here are a few questions to ask as you go through this process. Are the goods and or services you provide distinct, or are they part of a set? How do customers derive value from their purchases? Do customers need other resources to access your goods or services? And how does this factor into your product's performance? So going back to what I mentioned on the last slide, which was a bundle of services associated with a subscription of software. The reason I referenced it as a bundle was because it may be indicative of one performance obligation. There would be no activation fee and no support provided without the license. So perhaps you are recognizing these as one performance obligation. However, you can create a distinction between these items based on how the customers will be deriving value. Perhaps support is a separate obligation because it is not a necessary piece of providing the license. It is inseparable from the contract and distinct and would be a separate performance obligation. These are discussions you should be having with your auditors and or your 606 assessment consultants to determine what makes sense for your business. Step 3, determine the price of your product or services. This is the idea of a total contract value, and it's very important, especially for companies with those bundled services. How much will each performance obligation be? And then in total, what's the total contract value? When you're calculating this, make sure you consider promotions, discounts, and other terms that could affect the price, which Lagoya is going to get into later, because these variable items won't affect the overall total contract value. We won't spend a lot of time talking about these considerations right now, but just to make sure you consider anything that could ultimately affect the total transaction price over the entire length of the contract is important. Also account for the possibility of revenue downturn. I don't want to glaze over this step because it will prove to be very important when we get to the next step, which is allocate the transaction price to the performance obligations in the contract. So for a quick and basic example, again, say you determine that your business charges customers on a monthly basis and fulfillment of your obligations costs customers $10. So your transaction price is $10 a month. Very straightforward. However, this becomes more complex when a business supplies multiple products, as the value of each one needs to be defined. And that's where we get into the importance of determining that total contract value and having those solidified, predefined performance obligations. The calculation of allocating the transaction price down to the specific performance obligations is certainly a whole topic in itself, and again, may even be familiar for standard subscription business models if it pertains to your business model. So I won't bog you down again with the accounting and the math speak during the webinar. So let's move on to the last step. Step 5, recognize revenue as performance obligations are satisfied. Now that your business has identified its performance obligations, you can account for the revenue accordingly. To bring it all full circle, remember those questions we posed during step 1. What goods and services are you providing and how are you providing them? This will set you up for revenue recognition. Forecasting revenue should be a breeze if your contract terms are clearly defined and you follow the 5-step model accordingly. And again, this type of revenue recognition should look familiar for some subscription businesses. However, there are a few quirks that we want to highlight for the subscription business. So I'm going to hand it back over to you, Lavoya, to discuss this.
Great, thank you. But don't worry, many of the B2C subscription-based businesses, they're already taking most of these steps, if not all. And current accounting practices are most likely well aligned with the new requirements. That being said, you may have to estimate your future revenue more frequently. Some pundits noted that these new guidelines are more future-oriented than the past. But what's most important is to clarify your contracts, your performance obligations, and the price if you haven't done so already. Let's look at another example. Say you're a software provider that offers $9 monthly subscription for a cloud-based product. What does this mean exactly? Does it simply grant access to your product, or is there a usage component? Can customers access software freely during the month, or are they limited by the number of sessions they have or the amount of data they send or receive? The answers to these questions could impact the way you record and log the revenue. Now, think about when the customer is billed. Does billing on the first of the month align with your performance obligations, or is it better to send invoices on the last day? What about if you introduce a promotion? How does that affect billing? Say you want to give a customer a $12 discount off a subscription. So will that be a $12 off one payment? Would it be $1 off 12 monthly payments, or a $12 discount divided over 365 days? In many cases, there's no right or wrong answers. There are considerations for and against each one of these options, and the new guidelines can allow for more than one approach. Kristen?
Yep, thank you. Sorry. So what are you going to do now that you have to comply with these new standards? Although the new standards may only initially prove to be small challenges to your revenue management, can your existing systems handle the new promotional calculations that may be necessary? Because in my experience, relying on spreadsheets for 606 is going to be very tedious. If you're going to try to calculate the promotional discounts that he was just talking about and the discrepancies between your billing and revenue systems in Excel, you know Excel has its limitations. And I know we're both solution providers, so you may think we're biased when we recommend this, but don't rely on spreadsheets. SOFTRAX, we wrote a really great blog on it, and we outlined 5 reasons why we shouldn't rely on spreadsheets, and I'm going to outline them here for you. So number 1, Excel is error prone. The risk of finding accounting errors in spreadsheets is really high, simply due to the prominent level of human interaction. According to an article on marketwatch.com, 88% of spreadsheets contain errors. And the more complex the revenue, the more cumbersome and time-consuming these spreadsheets become. Number 2, Excel is not secure. Security risks are very high for finance and accounting departments that rely on spreadsheets to manage 606. Spreadsheets are a static resource with limited transparency into tracking transactional changes. It's unable to provide a detailed history of changes made to a range of multiple transactions, let alone individual transactions, ultimately making auditing a company's revenue in a spreadsheet a daunting task. To make matters worse, most companies don't password protect their spreadsheets, making businesses even more susceptible to cracks and errors, as I mentioned in number 1. Number 3, Excel is not intended for sharing. Spreadsheets weren't really designed with revenue management in mind, unfortunately. Revenue reporting should be a collaborative activity with a range of individuals and systems, but Excel doesn't allow for real-time editing between multiple users without a cloud subscription, and the audit log is difficult to decipher without significant legwork. Number 4, Excel is not an agile business tool. As your company evolves and grows, revenue data in a spreadsheet system gets more widely distributed. There comes a point for a growing organization where limits are reached due to scalability, and Excel is just not ideal solution for large corporations with multiple entities, multiple currencies, high volumes of transactions. The seemingly infinite number of worksheet tabs eventually just becomes a nuisance. As the company grows and demand for sales increase, a cloud-based solution scales accordingly. Number 5, Excel is not a reporting tool. How much flexibility is there really in an Excel report? Are your revenue analytics presented in a way that's both intuitive and clear? Pivot tables and charts are nice. What could you do better? What about a deferred waterfall report or a reconciliation report with the capability to drill down into the details at the line item level? Even our partners at the Big Four accounting firms are only recommending Excel in the interim as a Band-Aid solution if absolutely necessary. And they do that from both the assessment perspective and the audit perspective in mind, right? They're concerned with controls and security, which brings up our next topic. What happens if you get audited? The FASB and the IASB's main goal of updating the guidance is to provide more comprehensive and synchronized data to the shareholders, right? So your auditors will have to ensure you're compliant with these standards. So ask yourself, will the auditor agree with the contract you create? Will he or she accept that you've priced your products or services reasonably, or that your performance obligations make sense? These are questions you need to ask yourself as you complete the 5-step process mentioned before. They're also going to be very concerned with the support you provide for those decisions. Everything from the detailed calculations and the audit trail of the money movements down to the qualitative disclosures you provide on your decision-making process. And these are not easy tasks. However, they can be streamlined. So if you're still uncertain that your business's accounting practices adequately follow the new standards, we recommend you consult with a billing or accounting expert who can provide that specific guidance. And of course, SOFTRAX and Vindicia would be happy to help.
So in conclusion, here are a few takeaways. Overall, the purpose of these new revenue recognition standards isn't to make things more complicated for businesses. In fact, they're designed to do just the opposite. The FASB and the IASB created these guidelines to help your company clarify its obligations to its customers and record revenue in a manner that's consistent across all markets and industries. They also make things easier in case of an audit. As such, certainly for B2C subscription businesses, while you don't need to review your processes, there's little reason for anxiety.
Yes, thank you, Bogoya, for wrapping that up for us. We moved really quickly, but thank you everyone so much for listening, and thank you to Vindicia. We will post this to both of our websites, and we have additional resources on our website. We did leave time for Q&A, which I'm going to hand over to Stephanie so we can have some Q&A time. Go ahead, Steph.
Yeah, thanks, Chris and Magoya. That was a really great webinar. Actually, I was going to suggest maybe we should go back to the slide with the 5 steps and leave that one up for everyone to be able to reference. But yeah, as Kristen said, this is going to be on demand, so you guys can review it later or share with your colleagues. So we do have a couple of questions that came in. The first one, kind of a long one, someone asked if customers need additional resources, so say, for example, an internet connection to access the service, do they need to specify how the possible failure of that service affects their company's performance obligations? So either one of you want to take that one?
Yeah, so I'll take that. Thank you, Stephanie. So the performance obligations really depend on how you define your contracts and how you define your performance obligations. If, as a subscription business, if you say that you, in addition to your product or services, you're also providing, let's say in this example, an internet connection, then this the connectivity to your product or the accessibility definitely affects, and the performance obligations depends on it. Most subscription businesses don't do that, and they rely on existing infrastructure for access to that product. So it depends on your situation, but most likely subscription businesses don't put dependency on infrastructure as part of the performance obligation.
Great, thanks, Begoya. One more that just came in. Someone's asking, how do we account for this process within our systems?
Okay,
Kristen, you
I
want to
can
take
answer
that one?
that.
Great.
Yeah, I'd be happy to. Okay, so if we're talking about, from a billing and a revenue management perspective, it's kind of, both systems are set up to handle that together. So if we think about Vindicia and SOFTRAX integrating together, Vindicia is going to capture all of this contract data. So if we're looking at the same 5 steps here on the screen, Vindicia is going to handle number 1. They have to bring in that total contract value with their customers. And then SOFTRAX is actually going to identify the performance obligations based on the revenue policies that you've set up in the system. And then based on the prices that have been set up in Vindicia and transferred to SOFTRAX, that's how we determine the price of the products or services within those performance obligations. And then again, SOFTRAX is going to allocate the transaction prices out and do any additional policy or apply any additional policies there. And then we're going to recognize the revenue as the performance obligations are satisfied. So it's really kind of both systems need to work together because there are tons of complicated revenue scenarios where, SOFTRAX needs Vindicia. We need the total contract value. And if, I'm going to give you a complicated scenario for an example. If we bring in we bring in revenue that is being recognized ahead of the billing event, say you've given this person a discount and they're not going to pay until 6 months down the road, right? But you need to recognize the revenue associated with that up front. SOFTRAX is going to go ahead and start recognizing the revenue based on the contract that we get from Vindicia. But once Vindicia bills 6 months down the road, then they're going to tell us that they've billed it. And again, we're still recognizing revenue, but we need to talk to Vindicia and integrate with Vindicia to match that bill with what's going on from the revenue management side, so that all the accounts line up correctly. So it's a pretty complicated process, and we could spend a lot of time talking about it. But from a systems perspective, you probably need a strong contract or billing solution and a strong revenue management solution.
Yeah, that makes sense, and that really hits home to your point about not using Excel, and really wraps up the frame of reference for this webinar. So that was great. Thanks, Kristen. We don't have any more questions today, so we can close here. I'm sure both SOFTRAX and Vindicia will send you guys a follow-up email, so you're welcome to reply if you want to get in touch and speak with any of us further. But other than that, we hope everybody has a great afternoon.
Yeah, thank you everybody again for joining.
Bye-bye.